Hi, thanks so much for tuning in. This is BQ Prime, and this is an earnings conversation about Blue Star. Now, you've probably seen the headline numbers, but in case you haven't, the company has reported revenue from operations at 1,576 crore. That's a growth of 27% year on year. Its net profit is coming at 42.5 crore, and that is a growth of over 35%. The margins stand at 5.43%. We'll talk about segment revenue and everything that you need to know about. But first, let me introduce my guest. We've got Mr. B Thiagarajan, who's the managing director of the company. Thank you so much, Mr. Thiagarajan, for taking the time.
Good morning. Thank you very much. It's a pleasure interacting with you.
Absolutely. Like I said, sir, I think a lot of our viewers will already have seen the headline numbers. So I want to jump straight into the segments. And I think there's a lot of interest in the unitary product space. In fact, what you've been doing since the start of January with the introduction of the affordable segment and all of that. That has seen growth in the quarter despite it being seasonally weak. What is the impact of that introduction of affordable segment? And could you take us through a little bit of the numbers in terms of the output and the performance?
Thank you, Alex. I often wonder that this interest in B2C part of the business versus B2B is like the Test cricket versus T20 cricket. So it is taken as a vintage one. So Blue Star plays as is Virat Kohli in all the segments. We do have interest in B2B as well as B2C. The B2B segment is equally important, and it has contributed to our growth and profitability. Now, I will slightly wind back on the various narratives, commentaries on the consumer durable consumption. So we delivered great numbers in Q3 of last fiscal, Q4 of last fiscal as a whole. And as we entered into summer, the expectation was it is the first real summer after a couple of years, and there is going to be a huge growth. And April turned out to be a very great month. May first 15 days was exceedingly good. So much so that there were industry associations and the market and other observers saying that it will be a 70% growth, kind of the products will be stocked out. So if you recollect, I had maintained this, that I think the market will grow from 15 to 20. We will grow from 20 to 25. And in fact, I ended up explaining if the market is growing by 70, why we will grow only by 25. Then suddenly from May 2nd off onwards, the market collapsed actually. The demand disappeared. Now, then I went on to say that, look, you had a great January, great February, great March, great April. It is better to look at first 6 months what has happened. So January to June of FY20, January to June of FY22, which was not comparable anyway, but FY20 is very important. January 2019 to June 2019, that period belongs to FY20. Good summer, complete summer, that we will compare with January 22 to June 22.
Correct.
And I had established that the growth is 36%.
Sure.
Now, while it was a disappointment that May second half and June didn't behave, indeed the market had grown and we have maintained that growth momentum through Q2. Now Q2, I continue to say that the growth will be there over FY20. But there was suspicion that how it will be. Many other durables are not doing, but my view had been air conditioner penetration is low, and you are seeing the residential property consumption through ownership or rental has been doing good, and it will continue to do good. I am not claiming that we gained market share, and our market share remained the same in Q2, but we have shown the revenue growth in segment 2, which is somewhere close to 33% over, 15% over FY22 and 39% over FY20.
Okay. I'm curious though about the segment results, and we'll go to EMP. I'm equally curious about that. But you've seen a slight slide in the EBIT margins. You saw Q1, a significant improvement in the EBIT margin in this business in particular? I'm talking about the unitary products. Why is that? Is that because of the mix, or is that because you couldn't take price increases that you managed to take in Q1?
No, if you look at it, segment 2 margins, okay, it has improved from 5.1% to 6.2%. Segment 2 margin has improved. Segment 1, there is a minor drop from 6.4 to 6.3. It is segment 3, which is 16 to 14.9. I'm comparing with the previous year. Okay, so your question is relevant. If we wouldn't have increased the prices, I think the margin drop would have been somewhere around 12%.
Right.
We have increased the prices at frequent intervals. Here again, look at the thing that when April we had increased the prices. So there was a question, will you increase in July because of the energy label change? I maintained that we may not. Because sufficient increase has taken place, because you have to figure out what is the market operating prices of the competition versus ourselves and our market share goal. So therefore, we said we will maintain the prices. If at all, we will review in August, September. Prior to festival season. Okay, these are all there in YouTube. In plenty, I have spoken about it. But then commodity prices started dropping. Therefore, the question was, will you drop the prices? Now, I had gone on record to say this, that we increase the prices because of input costs. If the input costs are coming down, we will indeed be the first player to come and say, but even if we are not saying, the competition will make me drop the prices. Okay. Then about the margin. When the margin will begin to improve, because commodity prices have come down, will it improve in Q2? My prediction, our commitment was Q2, nothing will happen, because you have some inventory of finished goods as well as raw material. So therefore, Q2 you won't see. Probably you will see improvement in Q3 and Q4. That was the commitment which I maintained till around Dasara time.
Okay.
Then the exchange rate goes completely out of control. So the savings that you will get out of commodity prices is more or less offset by the exchange rate.
Sure.
So therefore, there is no question of dropping the prices.
Okay.
Now you will ask the question, what will be the margin outlook?
Yes.
I think you have to be playing more or less. There won't be any margin improvement in the coming quarter also, but I maintain the outlook of FY23 or the fiscal 2022-23 will be 8 to 8.5% in segment 2.
Okay.
In segment 1, it would have been 6 to 6.5. That is, we are clearly maintaining, and segment 3 will be at around 15%.
Okay. I want to talk about segment 1, which is EMP and commercial air systems. And you've seen stellar growth, I think, on the back of massive order wins over the course of the last several months. Could you give us a sense of Q2 specifically? What order wins were there, and what is the kind of execution that you're seeing? Is that gathering pace, and what's the outlook for the second half?
Order inflow continues to be good, coming from basically the factories and data center, infra, which is connected with metro railway or water or electrification, power substation, so on and so forth. The third segment is shop, showroom, boutiques, so on and so forth. And the next one is also the buildings, where we had written off offices post-COVID. We said that why people will go to office, once and for all things have changed. But surprisingly, offices are also getting occupied and getting expanded. In my view, we are back to square one. There is nothing COVID has permanently changed, is my view. There may be divided opinion. But the fact of the matter is, there is a manufacturing capacity expansion driven by that. It has not happened for many years, and there is a PLI scheme driving certain investments, backward integration, supply chain reorientation, manufacturers looking for export opportunities to North America or Europe, because China plus one will come into play. So that segment is happening, continues to happen. We are continuing to win orders. The Second part is data center. You can imagine it is a segment that is going to grow at least for next 5 years. It will continue to grow. That segment is more or less like a factories it behaves in terms of design, execution, so on and so forth. The infra government push and state as well as central government and public sector undertaking, water or metro railway, huge expansion is happening. That story we are benefiting from. It is not we are the creator of that story.
Sir, but I want to, I get your point, and this is, I think, well documented, but I think my viewers and your investors will want to know this 30% increase that you've seen in your order book as of September year on year. Is that pace of order wins, is that pace of order execution going to continue in the second half of this financial year? Do we see that trajectory continuing?
Yes, enough inquiries in the pipeline. Absolutely no problem. There is a last bit also I have to add. There is a healthcare investment that is happening in small hospitals across. And post-COVID, there seemed to be a opportunity for people to invest there and expand and modernize. That is an opportunity. Now, tier 3, 4, 5 are, whether it is retail, whether it is restaurant, whether it is cinema theater, whether it is small hotels, massive activities that are happening there. So this is, in a manner of speaking, a pent-up demand coming back as well. So I can comfortably say this kind of order book growth, order inflow growth, we have a visibility till March. And in my view, there is a construction cycle that is on, which India is benefiting unless and until some major event takes place. I don't think this will stop.
Okay. In terms of the supply chain issues and the reason why you've had higher inventories, I think is because of that. Is that kind of easing out, or do you think that you will continue to keep higher inventories in the second half?
We are compelled to keep higher inventory. I do not think it will ease till December, but we have spoken to a few vendors in the past couple of days, and China hopes that they will come to normal after Chinese New Year. In other words, that the zero COVID policy, there may be some rethinking.
So that is, of course, affecting financing costs to a certain extent, not that you have very large amounts of debt. But once that eases out, then would you say that in Q4, the metrics will improve even more substantially?
So our working capital has never been a concern at all. In fact, I was mentioning to some analysts a little while ago, when we tomed that we have cash surplus, and our borrowing is almost nil. Nobody bothered. They said it's not a great achievement. You are supposed to invest and your leverage is very low. And the question is that compared with some 45 crore of net borrowing, you have to see, because we have some cash sitting as well, it has gone up to 392 crores. That's all the story in borrowing is. Debt equity ratio stands at 0.37.
Yes.
But we have a capex cycle that is going on. Bada deep freezer plant we commissioned, and CCT something close to 220 crores has got invested. And we are expanding our international footprint. We had announced that we are opening an office we have opened an office in the United States. So therefore, working capital requirement has gone up primarily due to inventory and capex. Capex is needed, so nothing to worry. Inventory, it is in order. If you have stored for 45 days raw material, it is at around 75 days now. And I don't think you can take a chance there.
Sure.
And so the next thing is summer buildup will happen now from November, December. So in the coming quarter, if you have to ensure that your summer supplies are there in terms of components, we have to go ahead and invest in raw material.
Okay.
I am not seeing immediate easing, but the indications are it may ease after Chinese New Year.
Fair point. Last question then, Mr. Thiagarajan. I think you've guided towards 15% market share in FY25. Will you achieve that before that point? Is there any possibility of that, or is it slow and steady as you've been doing so far?
No, right now it is slow and steady because we have to manage the margins as well as this. So you will appreciate that we don't buy the market share in order to uh, be there. But the thing is, you have to be delivering the margin as well. As I told you, 8 to 8.5% operating margin we will deliver in segment 2. And we will probably improve this financial year 13.25% to 13.75 or 14. This financial year will improve. And 14 to 14.5 or 15, I am unable to comment at this point of time, basically because of this, that you will find many manufacturers commissioning their new facilities and the capacities will increase. And the PLI scheme, it is not based on the investment or production. It is over incremental sales you achieve over FY21. So x-axis is the investment, y-axis is the incremental sales. So everybody have to sell. So I expect competitive intensity to be very high. So it will be too early and vague for me to state that 15 we will achieve next year. It is not. And in a manner of speaking, the direction is as follows: that we should go faster than the market. We should build scale. We should deliver profits. Market share by itself is not the goal.
Sure. Fair point. Thank you so much, Mr. Thiagarajan, for taking the time, and always a pleasure speaking with you.
Thank you very much. It was a pleasure interacting with you.